Hello and welcome to another episode of Darwin Investors. This was supposed to be a glorious video detailing my grand exodus from the stock market at the very top, where I was going to lead a life of options trading and swing trading and just sitting in a very heavy Scrooge McDuck-like cash position. Instead, the market pulled way back on what I thought looked like very encouraging inflation data. However, the Fed emphatically disagreed, and so the market took a dive. As a result, I'm still fully invested in the stock market and I need a new plan. So in this video, we'll very, very briefly cover the summary of economic projections. It's kind of dry stuff, but I'll make sure it's really, really quick. We'll hit the high points because it's important to understand why the market reacted the way it did. And after that, we'll show how the retail sales data and the PMI data that came out last week has the bond market not quite believing the Fed's projections. After that, we'll look at the wage growth data and try to show from the Fed's point of view, in Jerome Powell's own words, how many jobs they intend to eliminate and why the Fed feels it's important to eliminate these jobs. Then we'll look to see if analysts are predicting some kind of Santa rally. And we'll also review what kind of investments that they believe that you should be in today and going through 2023. Finally, Moderna is getting very close to a breakthrough with a cancer vaccine, and we'll have a look at my trading portfolio and see how I did this past week. And here's a hint. Don't let me have a day off at home with my computer and the market open and Moderna well on their way to discovering a cure for cancer and not expect that I'm not going to be trading in and out of that stock all day long. We'll see how those trades went. All right, we got a lot to unpack, so let's go ahead and get into this. So here's a summary of economic projections that was released this past week. And what this is what the FOMC meeting participants believe is the most likely outcome for GDP, unemployment, and inflation for each year going from 2022 to 2025. Now, market generally takes this with a little bit of grain of salt because they have a lot of difficulty getting the next 3 months right, let alone the next 3 years. But for what it's worth, here's the summary of economic projections. Now, what's worth mentioning from this summary of economic projections is the change in GDP, the change in the unemployment rate, but most importantly, the change in the federal funds rate. And this is the one that rocked the market. Because right now you can see the change in the federal funds rate was 5.1%. Here in September, they thought that it would go up to about 5%, but by the end of the year, they would have it back to 4.6%, indicating that the Fed thought they were going to engineer some sort of pivot during the course of next year. And now what they're saying is they're going to bring it up to 5.1%, and they're just going to leave it there. Additionally, they said that the unemployment rate was going to go from 4.4% up to 4.6%, and that the next year's GDP was going to go from 1.2% down to 0.5%. And this is why you got to take what they say with a grain of salt. 3 months ago, they said it was going to be 1.2%, and now they say it's only going to be 0.5%. Also, how in the world is the GDP going to stay exactly the same in 2022 and 2023 when the unemployment rate is going to go up? That's totally illogical. So they're like, how in the world is that supposed to happen? And while I'm on the subject, how in the world, they're upset because the job participation rate won't go up. They want the unemployment rate to go up and the job participation rate to go up. You tell me how that's supposed to work. I don't know, but that's the Fed. But people don't necessarily believe this, and in particular the bond market, and the reason for that is because of the retail sales data and the manufacturing data that just came out this past week. When we look at the retail sales data, that fell 0.6% in November, and that 0.6% decline was worse than they even thought, because they thought it was going to be a 0.3% drop. When we look at the manufacturing index, that too was like a pretty shocking decline. The Empire State Manufacturing Survey, which measures activity in the New York region, posted a reading of negative 11.2 against an estimate of, get this, negative 0.5. So that's getting a lot worse than people thought it was going to be. Similarly, the Fed rose 6 points, but was still a negative 13.8 against the negative 12 estimate. Again, negative 12 is a terrible estimate, and they beat it somehow. They made it even worse. With exports now suffering from the strong dollar and a global recession looming, we expect that further weakness in manufacturing lies in store. When we look at the PMI that was just released here in December, it was 46.2. It was 47.7 in November, and it was forecast this month to be 47.7 again. Well, how bad is that? So the way that this works is if you're over 50, it says that's an expansion in manufacturing. At 50 is neither expansion nor contraction, and below 50 means you have a contraction in manufacturing. So let's see on a historical basis exactly how bad this is. So if you look at it on a 5-year chart, you can see that right down here at 46.6 is the worst since manufacturing was essentially shut off during the pandemic. It's the worst since the pandemic. Let's go ahead and max this chart out. We can actually see, other than the pandemic, so long as manufacturing is occurring, this is the worst of all time. Okay, on this chart. Now, this chart only goes back to about 2013, but that's how, I guess, how long they've been tracking this data, at least on this chart. So for this reason, and the retail sales slowdown reason, the bond market isn't really believing that the Fed isn't going to have to do some sort of U-turn in 2023. Now, bond traders dismiss Fed's hawkish tone, bet on 2023 rate cuts. Most Treasury yields drop after Fed slows rate hiking pace. I'm just going to hit the high points in this here article, but it's very important. The policy-sensitive 2-year Treasury yield initially surged after the Fed's quarterly forecasts released Wednesday showed officials expect the central bank to raise its key rate to over 5% in 2023. Remember, it's at 5.1%. Now they're expected to hold it for the entire year. According to the median estimate of policymakers, that's well above what futures traders are pricing in. They were pricing in the 4.6% at the end of the year, or a rate cut sometime during the year 2023. And why is this important? And why are they saying that's a very sensitive Treasury yield, the 2-year? So let's go ahead and have a look at this. So if we look at the 2-year Treasury, the way that this thing works is that the Fed sets a target funds rate, and the 2-year is usually somewhere just behind it. So if they're saying it's going to be 5.1%, then we would expect the 2-year to be some close number to it, maybe 4.7, 4.8, like somewhere close by. However, when they announced this, the 2-year Treasury went straight up, like it went up to 4.3. It says, okay, we believe you, Fed. But as they start to absorb some of this data from the retail sales and from the manufacturing data, the 2-year said, you know what, Fed? We're not really sure that we believe you. And as a matter of fact, they ended up finishing the week somewhere right before his speech actually started. So the bond market just isn't pricing this in. And that's what they mean by the sensitive 2-year Treasury yield, is not believing what the Fed is saying. Yields soon erase their increase, even as Powell signaled the central bank still has some ways to go. The dot plot revisions and downgrades for growth and employment are as close to a recession call from the Fed as I can ever recall. When we talk about the dot plots, we're talking about here in the summary of economic projections. If we kind of like scroll further down this, we're going to find these dot plots, and what they represent is voting members of the Treasury. And there's about 17 members. You can see that unanimously, there's absolutely no dissent at all. They all voted for a 0.5% hike, bringing the end of year rate to somewhere between 4.25 and 4.5%. Next year, the majority seem to be here in the 5.1%. And then we got this strangler that's sitting way up here. I'm guessing that's James Bullard. He's the Dallas Fed president. He's being replaced as of this month. He's going to have a new one, so you can probably erase these dots. But in the year 2024, we're looking at about 4.1. In the year 2025, they're thinking somewhere here between 2.5 and 3.1. So the only ones that really matter here, though, for the sake of the market, is the one for 2023, because they're saying you really can't predict this far out, and that one's going to be 5.1, and that's the one that they put in their summary of economic projections. So the dot plot revisions and downgrades for growth and employment are as close to a recession call from the Fed as I can ever recall. The Fed in its statement said it anticipated further increases to make policy tight enough to pull inflation back towards its 2% target. When asked about the rate cuts being priced in the market, Powell said Fed officials weren't even pondering yet the idea of easing ahead. Our focus right now is really on moving our policy stance to one that is restrictive enough to ensure a return of inflation to our 2% goal over time. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2%. The market appears to be ignoring the Fed's message. So let's go ahead and have a quick look at a video that kind of weighs what the stock market thinks versus what the Fed is actually saying.
Well, it's this gap between the Fed and the market boils down to a sharp difference over what recent data say about the current state of the economy, Kelly, and especially inflation and where it's going. Here's a little bit of my take on what the market's saying versus what the Fed is saying. The market says recent inflation data show it's falling. The Fed says 2 months is not enough. Core inflation is still 6% year over year. I need substantially more evidence, Powell said. Markets saying the economy is weakening, recession is likely, at least according to our Fed survey. Fed says, yeah, but the labor market's still hot. Wages are going to drive inflation. Morgan Stanley, writing, the Fed chair sees the recent round of weak CPI prints differently than the market. Both October and November CPI prints were downside surprises to market expectations, but not so much for the Fed. You can see this disagreement between the market and the Fed in the 2023 outlook. Median forecast of Fed officials for the funds rate next year rising to 5.15%. It had been 4.6% in the September outlook. But Fed futures prices trading at 4.4% for year end. That is cuts after a few more hikes. So the market sees the Fed en route to making another policy error by tightening too much and not taking account of low inflation and a weakening economy and maybe those earnings coming down that Pisani was talking about. The Fed is fairly hell-bent, I'd say at this point, on not making the last error by tightening too little and letting inflation continue to rip. Kelly?
Hi, Kelly. I think today is a realization that while the Fed is almost done raising interest rates, whether they raise 50 or 75 is sort of irrelevant at this point. It's the point of keeping them elevated for a longer period of time. That is what is going to continue to slow growth. So even if they stopped raising rates yesterday, and that was the last hike, by maintaining this level, every month that goes by, there's someone that's having to refinance their debt at a much higher level than what is maturing. And that is why I see more of a grinded out economy, a death by 1,000 cuts economy, because rates are going to stay high for longer. And we should get off of how many more rate hikes are left and focus on, again, higher for longer.
All right, so the market believes that a recession on the way, and this is because keeping rates higher for longer, it's going to make it very hard for smaller businesses or really any business to borrow. And the Fed is actually downplaying the idea of a recession and even doubling down, saying that they believe that we need a rise in unemployment in order to save the economy. Now, in these sorts of situations, it seems that the stock market is generally correct. And for this reason, we can expect a recession and we can expect a pivot. Now, let's go ahead, just for the sake of argument, let's have a look at the Fed's point of view on this issue. So from the Fed's point of view, what they're saying is that wages are very, very high right now, and we can't bring inflation down so long as wages are high. And wages are going to remain high so long as the labor market remains tight. So what they're trying to do is loosen labor conditions by driving up unemployment. And then that is in hopes of bringing down salaries, because their belief is that we cannot bring down inflation until we bring down salaries. Now, what we're looking here right now is we see the wages and salary growth in the private industry is up 5.3% year after year, and the average hourly increase for all workers is 5.1%. We can see from this chart here, this dates back to 2000, that 5.1% is pretty high. And so looking at this chart, what we're saying is they probably want it here somewhere in the 3% range, and the only way to get it down there is to tighten the employment conditions. So they're trying to drive the unemployment rate up in order to get the wages and salaries down to about 3% year over year, so that they can eventually get to their goal of 2% inflation. And so let's have a look at this next video here. This is Jerome Powell answering questions at his post-FOMC meeting press conference. And I'm going to basically distill it down to those questions that have to do with the unemployment rate and what it has to do with bringing down inflation.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the models suggest that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks.
No, it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately, and that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation, so that's why that goes up. And that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain, would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy, so that the ultimate cost of getting it out of the economy would be very high in terms of unemployment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain, would be if we failed to act.
So the Fed believes that the services portion of the inflation rate is a little bit too high. And wages falls under the services sector, as does housing. And housing is actually going to be coming down, and the Fed actually acknowledges that in their meeting. They say that come the middle of this summer or halfway through the next year, housing should be coming down, and so services inflation should be coming down. However, what they're really targeting is the wages version of the services sector coming down. And now a word from my sponsor. Guys, are you looking for something to drink while you pacify your time watching The Price is Right? Have I ever got the product for you? It's my sponsor this week, which is beer. You're welcome, America. I can't wait for the wheel to come on next. So my sponsor this week is actually Spaten. It's a fantastic beer, as we all know, and I'm not so pretentious as to not give this beer 5 Kate Rooney's out of 5. Now let's continue the show. This article here says there's going to be no Santa rally on the way, and stocks could soon retest their lows. Now, it's not to say that the market's going to go down every single day, and my belief is sometime in the next few days the market will actually go up. It does go up as well as down. It's not going to go down every day, but the stocks could retest their lows, and this strategist believes it's going to happen sometime in the first half of next year. But what do we do in the meantime? This guy has some pretty good suggestions about what we might be considering to do with our portfolios in the meantime while we wait for this market to make its turnaround. So what to do now? Emmanuel said his current market strategy is to play defense within the stock market, and he expects stocks could stage a slight Santa rally at the end of the year. And that's like I'm saying is that things don't always go down. It can go up for a little bit, especially if the bond market and the stock market doesn't exactly believe what the Fed's saying. Emmanuel then expects a retest of the lows sometime in the first half. Many Wall Street strategists expect a choppy start to 2023 with a test of the lows and improvement in the second half. Now, I have real mathematical data that would say that this is actually true. And should this video not go too long, I'll show it to you at the end of this video. We were overweight financials. We took that off and substituted it with consumer staples. In my almost 10 years of doing strategy, I have never expected to have a sufficiently defensive posture as to warrant an overweight of consumer staples. Emmanuel also said that he was overweight healthcare and energy. He said consumer staples and healthcare typically outperform when inflation is high and falling. We show upside to the market next year. The environment of falling inflation will be able to offset slow growth through a recession and really set up the cathartic buying opportunity. Sohn said the defensive consumer staple sector is not as attractive from a yield perspective as it had been. For the last decade, I would buy consumer staples for defensive posturing or, if needed, yield. Now that yields across the yield curve are higher, I don't necessarily need to get that yield from equities. I could just buy treasuries. And so if we're thinking about strategies for this year coming up, we could be maybe a little bit underweight tech. We could be overweight staples and healthcare. We could be overweight defensive stocks that provide a good dividend yield. We might consider to get into some investment grade credit, maybe not the high yield credit, the zombie company type credit, but maybe consider some sort of those sorts of credits. We can consider treasury yields, because before we just had a stock market, but now we have a stock market and a fixed income market. You can kind of play both sides of this fence. Now, I happen to do just a bit of trading, and I think for my trading portfolio, be it options, covered calls, selling puts, or what have you, I can get more return from that than I can from fixed income. So I tend to gravitate towards that direction. But should you be more of a passive trader, maybe getting into fixed income, sort of treasuries, or possibly investment grade corporate bonds might be the way to go, along with defensive sector type bonds such as healthcare and staples and energy, and then collect some of those dividends, though I'm not really high on energy at the moment, because a recession also does tend to bring down the cost of oil. And with the cost of oil coming down, you would expect that the energy stocks would come down as well. And historically, they've always traded sideways for over the course of 10 years. Be that as it may, a lot of these analysts seem to like energy at this time. I just don't happen to be one of them, but I'm not an analyst. I'm not a financial advisor, but I do like the thought of healthcare and staples and utilities. Those seem to be just fine. All right, so let's go ahead and take a look at my trades for the past week. This is what I've really been waiting to get to. This is actually the cheery section of this here video. So let's shift gears a little bit from a rampant unemployment to a cure for cancer, okay? So why is Moderna stock skyrocketing today? Well, Moderna and Merck announced positive results from a phase 2 study. This study featured a combination of Moderna's personalized cancer vaccine, mRNA 4157, with Merck's Keytruda as an adjuvant treatment for melanoma. And so this is fantastic stuff. Sent the stock up in a straight line. Shares of Moderna were skyrocketing 24% as of 10/21 Eastern on Tuesday. The huge gain came after the company, along with its partner Merck, announced positive results from a phase 2 clinical study evaluating experimental personalized messenger RNA cancer vaccine mRNA 4157 in combination with immunotherapy Keytruda as an adjuvant treatment for stage 3 and stage 4 melanoma. Well, this is incredible news. So we're talking about a company that's actually gotten through stage 2 of the clinical trials. Now, how many clinical trials are there? Well, there's only 3 phases, so they have one more phase to complete, and then Moderna is going to actually come up with an mRNA cancer vaccine for melanoma. And that sent the stock absolutely up in a straight line. So we look at 5 days here, the last 5 days, it was sitting here at about 165. As soon as they announced the success of this phase 2 clinical trial, which by the way is very difficult to get through, their stock went from 165 a share straight up to 206 a share. And then it went up to about 216 a share, and today it's settled down to about 193 a share. Now, I happen to be off work on one of those days, and so I was trading this thing in and out. And let's just see how my trading portfolio went on those days. So if we look at the custom date range last week, from 12/12 to 12/17, I made about $1,100 trading in and out of Moderna. Now, I also had it wasn't just Moderna that I was trading in and out of. I actually had down here one put on Adobe. I sold a put on Adobe with a strike price of $310 that expired on the 16th. I got $191. I cashed out of it for $189. And so that was part of it. But by and large, it was all Moderna. And the interesting thing to see here is that I first got into this at $212. And then got out at 214 and so on and so forth. But I first got in at 212. I made $1,100, and the stock right now is sitting at 193. And so how would I do that? Well, I was basically taking small gains. So if I got up $100, I got out. Now, I don't want to say, and I'm not advocating this for anybody. What I'm saying is that I got lucky. And so I'm not going to try and go full Sam Bankman-Fried where I'm saying that I have a method and I know what I'm doing or anything like that. This could easily have gone down as it did later in the week, and I'll show you what I did with that. So I was getting in and out, in at a lower rate, out at a higher price. And so I did this over and over again. Now, finally, I got in at 198.90, which I don't see it anywhere here, but I'm telling you that I own Moderna at 198.90. I don't know where that is. So before we look at my options portfolio, let's go ahead and look and see how I'm doing this month, and then we'll talk about what I'm doing from this day going forward. So we're sitting here, let's see, 12/1 to 12/17. This month, I've made $1,900 in options, and over the last couple of months I've made $2,900 in options, and just trading back and forth in and out of Moderna. And so, logic would say that I could probably just go into cash, do this, and come out better than just trading in and out of stocks. However, what I'm doing right now is I'm actually thinking that I am going to do what was suggested by some of those analysts and kind of go more into like staples and dividend stocks that trade at a reasonable price to earnings ratio. Get a little bit out of that. Plus, I'm going to do a little bit of this trading. And so I do own Moderna at 198.90. I do have a covered call sitting here with a strike price of $200 that expires next Friday. I collected $339 for this. And if Moderna should go over $200, I would make $110 on my underlying, because remember, I have it at 198.90. Plus, I still get to collect your $340. So this is a good deal. I also have Advanced Auto Parts that I hit a strike price of $146. I just got a dividend on them on Friday. That dividend paid $1.50 a share. I have 100 shares with $150. So I have Advanced Auto Parts, I believe, at about $147. If I sell this covered call and it goes out for $146, I get $44 for this. Plus, I made $150 on dividends already, so I come out ahead on Advanced Auto Parts. Nevertheless, it's the sort of stock that I am interested in holding right now because it pays a nice dividend, trades at a reasonable price to earnings ratio. And I can go ahead and just continue selling covered calls on this as well. If either of these goes, I don't really care. I'll buy them back at a lower price. Now let's go ahead and see what some other analysts might actually suggest that we should be buying for the year 2023. Now here are Friday's biggest analyst calls. And this is the sort of thing they'll give you on CNBC Pro. It's kind of clickbait. They want you to pay the money. I happen to like paying for it. I like getting these articles. I like getting the little TV that I get all day long. And so what are the analyst calls? And what makes these special is the fact they're giving you calls for 2023. And these are the people that make the markets. So we'll say like Wedbush reiterates Carvana as an underperform. They're saying go ahead and sell that one. Evercore names ISI names Apple as a top pick in 2023. Evercore is saying go ahead and buy and hold Apple for 2023. Evercore also says buy and hold BlackRock. Goldman Sachs upgrades Delta to buy from neutral. They're saying that Delta is a good spot to be in right now. Disney is a hold, Cyberbark, blah, blah, blah. JP Morgan says Meta is now overweight from neutral. Apparently, Zuckerberg is kind of getting his stuff together. He's kind of like saying, you know what, we're not so much a metaverse company as we are an advertising company. He's kind of getting his brain together. He's able to adapt, unlike certain other Tesla CEOs that can't quite figure out what they're supposed to do. Zuckerberg is a little bit malleable. He's like reasonably adapting to other people's points of view, and he's actually turning them back into an advertising company and less from a meta company. Who knows? Maybe they'll actually change their ticker symbol back to FB in the future. Who knows? All right, JP Morgan reiterates Amazon is overweight. No shocker there. Walmart's a top pick for 2023. Eli Lilly, top pick for 2023. Yeti and Traeger, top 2023 picks from Canaccord. That's a little bit surprising. Datadogs outperform. Charles Schwab's a top pick from 2023 by Deutsche Bank. Bank of America names NVIDIA a top 2023 pick. JP Morgan names O'Reilly and AutoZone as top 2023 picks. Noticeably absent from this list is Advanced Auto Parts. Come on, Advanced Auto Parts, you guys can recognize, but they do need to actually improve their margins, actually perform better to get in this list. This is a respectable omission. I can admit that. Let's see what else is on this. So that's pretty much it. So those are the calls from this year. All right, so if you got anything on this video, yeah, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a great day. Bye. And now a word from my sponsor. Guys, do you... Ah, shoot. I can't remember. What was I going to say? I can't even remember.
You want to know what's great for the economy? Beer. Why, you may ask? Because I can be off and drink beer. Yeah, that's fine.
God! And now a word from my sponsor.